Hey guys, welcome back to the Results Junkies podcast. And if you're catching us on YouTube, welcome to the first video episode of the Results Junkies podcast. Over 100 episodes strong on audio, but we have finally made the plunge to publish, which means I will not be able to look down and surf Instagram and TikTok the entire time, trying to avoid listening to my co-host, Paul Singh.
This is going to be fun. I too happen to look around all the time, do other stuff. So now we're going to try to stay on target here. We'll just see how that goes.
I'll admit I have a little bit of a head start. I got 5 months of work on my other pod where we've done video. I'm getting better at that connection with the camera. But for folks who are just tuning in, show@resultsjunkies.com is the best way to get a hold of us. Shoot us emails if you want to pitch on the show, questions, comments, all that good stuff. As far as social media is concerned, he is at Paul Singh on all those social media channels, at Pizza in Motion, and we would love it if just a minute to leave us a review and a rating. And then if you're on YouTube, there's a little button there somewhere that says subscribe. So if you hit subscribe, it will help us as well. Today we're going to talk about Carta and some controversy that happened with them. Paul and I were getting all fired up in pre-show and finally had to say time out. Let's hit the button and save some of the fire for the show. And then there's a Wall Street Journal article that talks about the value of startup valuations, and we want to talk about what that tells us about trends right now. So lots to talk about, Paul. Just want to take
on the edge of your seat.
I am on the edge of my seat. I want to take a moment to recognize that not only have you hurtled into the 21st century with a computer that takes less than 45 minutes to boot up. I'm pleased that for longtime listeners of the show who will have heard me pester you for, what probably has to be a year now.
I would say it was about 119 episodes, so probably 2 years, actually.
What I would say is that the eventual ending of this saga is storybook and ended exactly the way that you would have imagined that Hollywood would have ended it, in that not only did you not get a single bonus mile for purchasing a new computer, that in the end you waited until the computer actually died and then overpaid for a monitor from Apple that you probably didn't need when you got that euphoria that they pumped through the AC at the Reston Apple store. Am I right?
Yeah, I'll own it. I'll absolutely own it.
Did you buy a couple extra HDMI cables from them for like $79 a piece too?
No, it was included in the box, sir. No, yeah, I waited all the way until that hard drive failed and found myself dead in the water. So sure enough, I had to go and buy something right away because there was no backup plan. So I will stay ahead of it. But yeah, you're right. I lost my miles on that, or I didn't get any point miles on that. I have clearly disappointed you, but I'm an optimist. So now what I'm really interested to see is what you will find to pick on me with for the next 119 episodes. We'll see.
I'm sure I'll find something, but I am also curious too, since it was last minute and you were talking about some pretty advanced specs for what you were going to buy for a Mac. What did you actually end up buying? And I know this isn't I know we didn't talk, VC stuff, but I am curious what you ended up with.
I picked the 14-inch MacBook Pro with the M3 Pro and the 18 gigs. It's off the top of my head, I think at the time that I purchased it, there's 6 versions of the 14-inch, and this one is 2/3 of the way over towards the top, right before you get to the M3 Max. And it's actually I actually bought it thinking that I would just try it out for a week and then maybe trade it in for the Max. This is working great. It's like the next model up. The next model up is about another $800, and I don't know that I would get another $800 worth of performance out of it, given what I do on a day-to-day basis. So, but it is wild how far the architecture has come, though. The things I'm able to do, the resolution, just wild to see. This to me sort of felt like going from an iPhone 5 to an iPhone 15 overnight.
Yeah, and I think in your specific situation that's probably the right computer for you. I think so. I did buy a new Mac because we have somebody in the company that needs one, and so I figured I'd buy one and hand down my M2, which isn't anywhere near ready to be retired. You don't necessarily have a team of people that you can hand computers down to, but I think from everything I read, the Max chips, so you got 3 chips now. You've got the standard chip in the latest version of the MacBook Pro. Then you've got the Pro chip, and then you've got the Max chip. And most of what I read about performance was that most people are going to be fine either in the regular bucket or the Max bucket. And so when I upgraded the machine that I bought one with a Max chip with the assumption that just based on how incredible the battery life and all the other performances are with the machine, and the fact that storage really hasn't grown considerably since I bought my last computer, because so much of what we do is stored in the cloud. I just envision my laptops lasting longer, 3 years, 4 years, 5 years, not like yours where, it takes 45 minutes to boot and then ultimately just dies on you. But that you can get, 3, 4, 5 years out of it, no problem. And so I did buy a Max chip machine with the thinking that, 5 years from now, I might need that processing speed. I certainly won't need it now, but it felt like it was worth the extra. I don't think it was $800 on the 16-inch. I think it was $400 or $500, but it felt like, call it $100 a year over 5 years. I felt like it was worth that investment. But, certainly I think like there's distinctions here for folks who aren't doing a ton of like heavy processing that you may not need the Max. It's just in a question of like, could you have gone with the regular instead of the Pro?
Yeah. And we could probably make this a whole episode, but I would just say like, all joking aside, one of the biggest reasons why I had not done or why I had put off the update for so many years was that, that particular computer, that it was a 2017 iMac. And if you kind of like look back at the last 7-ish years of Mac OS X development or improvement, over the years, over the course of that 7 years is when, Apple Cloud storage and all that stuff started coming in and synchronizing settings and Dropbox and, and the point is I was just putting it all off because eventually I was like, I don't want to have to find every single file. Because today I'm in the cloud, but that particular computer had a lot of stuff on it that was just, not. And it turns out I was okay. But the point is though, is that I actually think going forward, I don't think I'm going to go on a 7-year refresh cycle. I think I might do like an every other year refresh cycle. And, the hardest part of that first full day of turning on this computer was trying to verify that everything that I could get off that old computer got off that computer. And not only that, got then clearly put into, the Apple cloud storage utility and all that. So anyway, super nerdy, but I think that like my upgrade cycle will probably be every 2 years now. And we'll just kind of see how that goes. But anyway, M3 Pro for now. And I think I have like another couple days if I want to do it within the 14-day trade period, but we'll see. I don't know.
The one thing I'll say about the new computers, we use Dropbox pretty heavily. I do have some Apple storage as well, but we generally tend to put everything in Dropbox. And the corporate version, our size limitation is essentially unlimited. It's like I really like I never really thought I'd get here, but I really view my computer now as an appliance. Switching to a new one, I have a few apps I have to download, but honestly, like everything is in the cloud, which is both good and bad. But moving computers has gotten significantly easier because it all just, everything just gets reconnected to the cloud and away I go. So to your point about switching, you're dealing with probably the worst of it because the hard drive died. But if the hard drive didn't die, I bet you your next move is probably much simpler.
Yeah, absolutely. I agree. And like, given where I'm at with my family now, the idea, the Apple, like, so I actually canceled my Dropbox service a few weeks ago.
Okay.
And so part of the reason that I did that was because, between my computer, Dana's computer, Eva's iPad, the Apple TVs in the house and all that, by bringing them all under one family Apple ID, I can centrally like do parent things like control, what Eva can access or not access. But then you have shared storage and all that stuff. So a lot of the features that they have, like Dropbox as a storage system is wonderful. Dollar for dollar, probably the best value you can get right now, I think. But for where I'm at personally, the Apple ecosystem and that sort of family set of parental controls and synchronization and migration abilities, it's just so easy right now. So, but I agree with you. Like, I think that it is interesting to think that, just as recently as 20 years ago, we probably all looked at laptops as a convenience item, because desktops were where it was at back then, right?
Right.
And now, the thing is, like, it really is an appliance. You can't really function without it. Just really interesting to see how far we've come.
Yeah.
Eva's really starting to get into STEM stuff right now. So over Christmas,
yeah.
she got like a STEM like circuit board thing. And, I did the obligatory dad thing where I tell her like useless facts that she doesn't need to know. But we were doing this like circuit. We were making this like circuit on this like little STEM kit that she got this past Sunday. And I was like, hey, look, this is a switch, and we got into transistors. And if you can imagine it, it's like this big breadboard looking thing. And so there's this one transistor you put together and it's like, 6 inches wide or whatever. And I was like, hey, this iPhone that I've got here right now, how many transistors do you think are inside of it? And in her head, I could see her brain turning, and she's looking at the one in front of her this big, right?
Yeah.
And so I'm like, she's like, one? And I was like, yeah, no, and I Googled it right away. And I think off the top of my head, like an M3 has like 19 billion or something like that. And her face just like, mind blown. So anyway, all right, let me stop there because I could talk about this forever, but it's fun to see her get into STEM stuff.
Yeah, it is. And our kids, I remember those ages with our kids and similar realizations. All right, so let's talk about this Carta thing. And I'm going to frame it up in hopefully the most antiseptic way possible because I think there's a debate here. So I don't want to editorialize. So what I can tell from facts, having read through everything, and you flagged this a handful of days ago, Carta, for folks who don't know, Carta is they're certainly very popular. I almost hesitate to say that they are the standard bearer, but I mean, I feel like they are at this point. They are, for the vast majority of our portfolio of companies, they manage the cap tables for all the companies. So when we first started getting into investing again, because we were in very early, years and years ago, but when we first started getting back involved was 2009, 2010, and you'd have these big messy spreadsheets and you'd like be trying to verify share numbers. And when you did pro rata, like the lawyer would have to pull out the abacus and it was a pain. And then Carta came along and did two things. First off, it helped on all the investor side of things by keeping track of all this stuff, but Carta also has the ability to manage ESOPs, stock option pools. And so, again, another thing that was a challenge for founders. And I think what we found in our portfolio companies, and this is me editorializing a little bit, but what I think we found was that like there are things that founders are great at. It's almost never accounting. So things like QuickBooks and trust funds for, employee collection of Social Security and Medicare and, share exercise dates, all that stuff, like that's not their forte. And so Carta really stepped in to solve this problem. There were others, but Carta's the one that's been one of the biggest to solve this problem. And the recent development that's caused a lot of buzz in our world is, so essentially a founder came out and accused Carta of trying to create a secondary market for shares in their company. And when that information came out, more than one founder came forward with concerns. Some of them were similar concerns. Others were more nuanced. So somebody raised a concern about how they had a problem with ESOP language that Carta had put out that essentially removed certain transfer restrictions to make it easier for people to sell shares. And so, while that change in and of itself in a vacuum might not seem nefarious, when you fast forward to Carta potentially trying to build a secondary market, it accelerates this level of distrust. So I think, I'm going to stop for a second. Anything there, Paul? Do you think I've editorialized what's happened so far?
No, I don't. No, I mean,
cool.
I'm tracking with you so far.
Cool. So here's where we get to, like, Paul and I started debating in pre-show about, where Carta, I don't want to use the words like right or wrong, because I don't know what their terms of service say, but like where this is in the spectrum of proper versus improper. And I think along the lines of where we'd started the discussion was, I felt like Carta may not have crossed a line yet. And it felt like maybe you thought they had. Is that a fair assessment of where we got to?
Yeah, I think so. Yep.
And there's not a ton of information out there. I'd say let's start with, why don't you share why you think Carta has crossed a line?
So here's the thing, like The fundamental issue here, I think, is that Carta contacted other people on that same cap table that did not expressly opt in to those offers. They contacted people on a cap table without the permission of the owner of that cap table. So just to kind of cut to the chase, I don't think the issue is not that Carta tried to facilitate a secondary sale. That is not a issue. They were making money off of that. People knew that they were doing that. The actual issue here is that the only reason they got caught is that they contacted a particular person on a cap table that had not been listed anywhere else publicly. And all of a sudden, that's where the red flag got raised. And people started to question whether there were really any security protocols in place inside of Carta. So let me pause there, because I can kind of go deeper and deeper, and I'd even give you an analogy on why I think this is kind of a big deal.
Yeah, no, let's go for it. Shoot the analogy.
Well, think about it this way. So, for example, I use ConvertKit on my email list, for my email list at Results Junkies. You're using MailChimp for Pizza in Motion. Now, would you agree with me that Results Junkies and Pizza in Motion are two different entities.
Mm-hmm.
If I gained access to your email list without your permission and then emailed the people on that list something without your permission, would you be okay with that?
I would not. I see where you're going. I'm not sure I agree it's a direct comparison, but keep going.
Well, yeah. So the answer is you wouldn't feel comfortable with that. Now, on the flip side, if I emailed my list and somehow, through some combination of email marketing and SEO and pay-per-click, if I started creating content to, I don't know, target your readers, but without accessing any private data, would you have an issue with that? I mean, you'd probably be annoyed by that, I think, but is that wrong? Like, is that like, did I break any real rules by doing that?
No, you didn't break any real rules, and I do think there's a gray area here, because we're talking about things that are, because we're talking about, say, like Miles to Go and Results Junkies. I think like a better corollary might be if you and I were competitors and I got the control of the list. But in this case, on the other side of the spectrum, I'm going to use the example I used with you in pre-show of.
Yes. Now that's where we should go next, of course.
Yeah, because I do think there's a gray middle here. So like if you and I are investors in a company together, which oddly we were and didn't know it for a while, and I wanted to buy some more shares in that company, it wouldn't be out of the realm of reasonability for me to go. So like the company that we were co-invested in was led by Techstars in their accelerator. I might call Nicole or Jason and say, like, you guys from Techstars, be like, hey, like, I'm looking for some shares. Do you know anybody who's interested in selling? I've always viewed that as okay. And it feels like where people are getting really upset about Carta is that we're drifting further away from my example and closer to your example, where it's somewhere in the middle where, and I think there's two problems here, and there's definitely a bifurcation. The first is the one that you brought up about the information itself. If somebody's an anonymous shareholder, do they have the right to remain anonymous? And I'd really have to read through the shareholder agreements to understand, because I don't know that there's anything, and you'll stop me if I'm wrong, but I don't know if there's anything in the specific documents that protect me as an investor in some level of anonymity right now.
No. So is your question whether or not there's any privacy guaranteed to you as a shareholder?
Right. I don't think there is.
No, I'd have to, obviously,
there might be custom
paperwork's different.
There might be
NDAs in place, and
there might be, but and there might be general customs about like people don't share shareholder lists and stuff like that. But I think as a general rule, I don't view the fact that I've invested in Acme Corp as proprietary information that I don't want shared. I might want to downplay it. Maybe I don't put it on our website or whatever, but I don't view it as protectable data. So, but then there's this next logical question of, okay, if it's not protectable, can someone, and this is the two-part question. If Carta just facilitated you and I talking to each other about selling shares, are you okay with that?
Give me the scenario one more time.
Sure. So like you and I are both shareholders in Acme Corp, and I call Carta, or in the metaphorical call Carta, say like, hey, connect me with other shareholders. I want to buy more shares in Acme Corp. Are you, if Carta does not have a financial interest in that and they're just connecting the two of us to make an independent transaction, Paul to Ed, do you have a concern with that?
I think I do. So let's go back to your Techstars analogy first. Look, there have been it happens. I mean, like if you and I are shareholders in the same company, I've been part of a lot of transactions over the years where, a founder will email the private list of investors and say, hey, somebody needs some liquidity, like that happens. It's not these are all related parties, this is all like, and it's in these, so I don't know, informally, these things happen and it's normal. I think where this gets really, really fuzzy is, in this case, you have a vendor who did not expressly get permission to market to them. And I guess where I'm going with this, Ed, is, I take your point that, this stuff already happens and, effectively your point, it moves on to become like, what's the big deal? But I think the real concern is where does it end? How far does this go?
Well, yeah, but just to be clear, like that's why I was trying to split the baby. If Carta's not making money off this, do you have a concern? Like if the water's edge was Carta connects Paul and Ed, is that a concern?
Are they? So you're setting up your question as if they're not making any money, do I care?
Yeah,
I think so. Yeah, because like it's still the thing is though is that like. I just worry how far of a slippery slope. Like, if we're going to go down this intellectual kind of angle that you're going down, right? The real question is how far is this allowed to go? Like in other words, let me take your example maybe one step further and see how you react. Let's say that Carta has all this data and decides to create a public directory of everybody's cap tables. Like where I could go on and say, hey, I want to opt in and put my hand up and say, I'd like to buy a share of Palantir. Anybody want to sell? And then they somehow email the shareholders of Palantir. Like, would you be okay with that?
Okay, so first off, I do want to buy shares of Palantir. So so you picked a good one. But I think so are you asking me if I'm a founder or if I'm like an outside buyer? Sorry.
Well, see that's where it gets really interesting because
sure. Yeah,
because the answer is very different.
Because I'm an outside buyer, like rock on. If I'm but here's the thing, and this is why I really was trying to like draw a hard line here, because I really view these two things as two very separate things, and I know you're trying to slippery slope them, but I think these things should be resolved in terms of service. So in terms of service, as a founder, and to be clear, I'm not trying to absolve Carta of what they did. I don't know what these agreements look like. And now I want to go talk to a couple of our founders and be like, hey, like send me the terms of service from your Carta agreement. Like if it were me building a company, I would paint a bright line, but I would say like, do you want Carta to facilitate conversations in between your shareholders? Checkbox, yes, no. Do you want your shareholders publicly available for secondaries? Yes, no. And those things would be available to me as a founder to make those decisions as to whether I wanted to facilitate those things. Because at the end of the day, and maybe it's just because we're talking about Carta and we're talking about the utility of the product, but I think at its heart, I've always thought of Carta as a utility. And so if they were going to move, like if they're going to move into these other areas, then like anything else they're asking me, like, as you well know, you don't have to use Carta to manage your ESOP if you use Carta to manage your cap table for your paying investors. You can choose to manage your ESOP in an Excel document.
Yeah.
It's a feature that Carta offers, and they charge appropriately and all that stuff. So I view these other things as like, I think there's explicit opt-ins and permissions that should be there for those things. And if they don't exist today, when we draw that split, I would not crucify Carta for connecting you and I. I would start to have serious concerns if they were monetizing it without telling me. And that's like where my line is. Like if you tell me that as a service they're going to connect investor A and investor B, and then they're going to make money at the final bit because they're going to handle the paperwork of it, that feels a lot to me like AngelList and like what you would pay to have them syndicate for you. They don't have upside. Whether the deal, like they're like, the way I see it is, and I think I'm enunciating this poorly. I like if Carta, if the goal is for say, all right, here's the service that Carta offers, we can offer peer-to-peer selling of shares, and we charge, 2 cents a share to do that. I don't really have an issue with that. If Paul and Ed are selling, if Paul's selling shares to Ed, and I'm Carta in this situation, and I'm going to get 1% of the deal, I have a big problem with that, because now the value of the company and the size of my share play a role in how much money Carta makes, and now financial incentives are not aligned. If I'm providing a service and I'm connecting people and I'm charging a fee, Carta's still just a toll road. It's like, hey, this is what we charge to manage your ESOP. This is what we charge to manage your cap table. This is what we charge to connect investor A to investor B, which again, I think is similar to things that AngelList does. Once you get into Carta making more money off of the best companies, or having inside information about the fact that company A, like 10 investors in company A are selling because they're jumping ship because they heard bad information, and then they can act on that information, that's I think where that's where my line starts to come in.
I think if I were to summarize my position on this, I think it comes down to 2 buckets. The first is expectations, and I'll explain in a minute. And then the second is potential liability. So the first is that expectations bucket. That you talked about this idea of having check boxes to opt in. Yes, absolutely. That, like, the fact that those didn't exist, they should exist. Nobody expressly opted into this. We
don't think so, to be clear. We don't think that the current agreements allow Carta to do this. They may. I haven't read them. I doubt that I doubt the Carta agreements allow them to charge a percentage.
I've used Carta for, I don't know, I feel like 10 years now or whatever. I can't recall a single time I ever got an email from Carta that said, hey, would you like this secondary or whatever? I would be surprised if there's anything in the TOS that allows them to do this. But anyway,
I actually take the other side of this. I actually think that there probably is, only because I think very broadly you could I think very broadly there's probably a path for them to do this, but it's sort of like, and I think this is a bad example, but I can't think of a better one at the moment. But it's like, when Uber started operating in New York City, and New York City said, well, look, there are these laws, and like to operate a service in New York City, you either have to have a medallion or you have to be a black car. And Uber was like, well, we're neither of those. And New York City said, well, tough, then you can't operate here. Similarly here, like, this is an undefined area, and it seems like Carta is pushing the envelope, and it seems like the cardinal sin here is, in pushing the envelope, it feels like to me the part that I'm most upset about is when the financial incentives became misaligned.
So here's the thing. So there's this expectations bucket. There was clearly some misunderstanding about what was going to happen, and to your point, whether it is or isn't in the TOS, it's a good point. But anyway, it should have been an opt-in kind of thing. Or it should have been an opt-out thing, right? Like, that's just it. And then there's this other side of it, which is the potential liability side, which is and for the attorneys listening, don't crucify me on this, but, depending on who you start to market those securities to, you could find yourself as a company inadvertently on the wrong side of an SEC investigation.
Right.
Because, like it's one thing for me to go out and fundraise as a founder because I know what I'm getting into, and I'm choosing to either invest, within the private fundraising rules, or maybe I use the crowdfunding rules, but I explicitly opt in and I know what liability I'm walking into.
Sure.
In this case, the company whose securities were marketed had no idea that they were being offered to somebody else. And more importantly, whether the people they were being marketed to could have been unaccredited or, like all that stuff. So there's this liability bucket that's kind of scary. Now, all of that would get resolved if we had that first bucket figured out, which is expectations. Either tell me to opt in, ask me to opt in, or tell me to opt out. But whatever solution they choose there is going to determine how much liability I pick up on the other side of this. One thing I'll just point out, by the way, is that so just full disclosure, like I'm one of the investors in AngelList, and AngelList
Right.
I don't think is a competitor to Carta, but they are similar in the sense that AngelList is sort of the what I would call like sort of the de facto leader of fundraising for startups, just kind of like Carta is the de facto leader of cap table management.
Yeah.
And one of the unsexy parts of, I think, AngelList's history is that, 10, 12, 13 years ago, something like that, they went the unsexy route of making sure they got an SEC no action letter before they started doing this stuff. You had to opt in. Like they did do their research, they did do their homework, and they did do the extra legwork at the beginning to make sure that, they basically said, hey, look, we're pushing the envelope here a little bit.
Right.
They went to the SEC. They got a no action letter, as I recall.
Right.
For anybody listening, the simple term there is that as long as you talk to the SEC and you are clear about what you will and will not do, in this case, they got a no action letter that said, hey, we're the SEC. As long as you operate within this predefined box, we will take no action against you, unless you're fraudulent or whatever. And that became the basis of how they were able to move so quickly on figuring out how to do SPVs and all those things. In this case, this was like sort of, I think, a very cavalier thing. They just started emailing people, and luckily it didn't get too bad. They got, it stopped before it got too crazy, but it could have been a slippery slope. And the thing is historically, it's not like the SEC is going to go after the middleman. I mean, they might, but historically it's the company that's going to get the receiving end of the big stick. And then that hurts a lot. That could be the difference between that company surviving or not, So anyway, like I know we're both coming at this from a different angle here, and that's probably normal, but
yeah, but I think as we've staked out the positions, I think we've both moved to a more comfortable middle. And while there might not be a perfect answer here, I think we're probably closer than maybe I would have thought we were in pre-show. Yeah. I think, like when I think about this stuff, and again, I continue to think of AngelList as a really good comparison here, not because they sell the same thing, but because there are, the problems that both would confront in these sort of areas, they sort of rhyme, if you will. And I think you illustrated very clearly the different approaches that the two companies appear to have taken. AngelList took a preemptive approach to how they were going to carve out their territory, and Carta seems to have been, sort of, again, I don't know how, without reading the team terms of it, I want to be careful not to just jump on and pile on Carta and say like they did this unknowingly, because, I mean, like we all click the boxes. You and I joke about it, but if there's explicit stuff in there that gives Carta this permission. Well, I mean, shame on founders for not reading that. So, like, I do think there's I think there's a little bit more detail there. Like, I think we're quick to condemn companies when they do things like this, but we don't know how explicit Carta was about this. And, like, I'm going to tell you a quick story about a company that we were an investor in, and you'll know the bad parts of this story as we go through it, just because I'm sure you've been through similar things. At one point this is what company we're on the board of, and the founders disclosed to us that they had taken the trust fund money, which is the money that's set aside from employee checks, their contributions to Social Security and Medicare, and that they were using that money for ongoing operations of the company. And that was a massive red flag to us, because people go to jail for stuff like that. And so we jumped on it, and they said, well, like our CPA said it was okay, and other founders told us it was okay. And we're like, this is not okay. Full stop, call your CPA, get them on the phone. And as soon as we got the CPA on the phone, the CPA was like, no, like, hold on, like here are our written communications to you about things that we've said. And our contacts for the company are like, right, but remember when we were on the phone with you and we talked about XYZ, and the CPA is like, sorry, I don't recall that specific conversation, but here's what we put in writing. And the CPA was so specific about it. It was so CYA that it really made me think, like, they probably did say something like, well, like, if you need to borrow it for a couple of weeks, like, as long as it was there by the end of the quarter, I guess there's no harm. And that's this slippery slope. And here it's like, it was incumbent upon those founders to understand what their legal obligation was with that money. And I think it's incumbent on them, the founders, to have read whatever Carta's rights are in this agreement.
Yep.
I have one more question for you on the Carta thing, but I want to give you a chance to comment.
No, I think these are like, I guess the only comment I'll just make is like, these are like sort of those corner cases that can potentially snowball into bigger problems. I mean, that's why this is like turning into such. I think it started out for Carta as a PR mess, given the way that the founder responded to the complaint on Twitter and stuff like that.
Yeah.
But I think it's sort of snowballed into the concerns of the corner cases here, because when it comes to legal and finance, particularly regulated parts of, the finance industry, the sale of private securities, things like that, that you're stepping into territory that can get expensive, fatal to investors, and that sort of thing. So let me pause there. Let's ask the question that you got.
Yeah. So let's just say, and for folks who this is your first show watching because it's our first video show, you won't know what the listeners know, which is we frequently tee up a number of topics and they don't get to all of them. So we will not get to all of our topics today. This is the one that we're going to end on. But here's my question to you. You're a founder right now who uses Carta. Are you, there's news out there. The CEO of Carta has come out and said that they are exiting the secondary trading business. Knowing that Carta is by far and away the leader in this market, do you move your service now? There are other people that do this, maybe not as commonly. Do you switch from Carta?
I mean, so full disclosure, I'm on the investor side. So my interaction with Carta is really just receiving the stock. So for me, I don't really have any urgency to move. But if I was a founder, if Carta doesn't sort of clean this up a bit, it might be on one of my lists to kind of figure out how to clean this up, or at least potentially remove the liability later on. Like, the thing is though, is that like the possibility of risk here for a founder and frankly for the board that founder reports to is the material thing that has to be considered.
Right.
So I think if founders aren't out there reading their TOS right now, Carta's TOS right now, they probably should be. But for you and me as investors, like,
no, not for investors, but for founders, I think my 2 cents to founders would be, if you can't find the TOS that you signed or agreed to with Carta, you should email somebody at Carta and ask for it, and you should read it clearly. And if any of that stuff disagrees with you, you should go see what else is out there. The only thing I would say is that given the way the marketplace exists for these things, if Carta has taken some liberty with how they've structured their terms of service, I would bet that their competitors have too. So then you have that, then you have that to contend with. Because quite frankly, like we have portfolio companies where their terms of service have been copied letter for letter. Their terms of service aren't hard to get a hold of. So if Carta is the leader, it wouldn't surprise me if large parts of their terms of service language are very similar to their competitors. So there may be an instance where all of the major players have opacity around what their rights are here. And so as founders, you should understand what that is.
Yeah. I mean, it really just, again, here's the thing. It's probably going to be in Carta's best interest to figure this out sooner rather than later. So it's probably going to be okay. But I think that, for the founders, you got to cover your butt on this. I think, if I guess to kind of maybe summarize what I would say to, in response to this to you there is, I would just say that like if a founder accidentally just clicked the accept button of the TOS, like we've all done over the years, that's one thing. But, the
As
tricky
I'm sure
part
many
here,
have done.
yeah, we've all done it. I mean, Lord knows I haven't even read the TOS on this platform we're using right now. But, the thing is, though, is that like now that we know that there's at least a question of whether or not our data can be used, well, now you, as a founder in particular, need to go read that thing and at least decide if you're comfortable with it. Because if something were to go wrong, whether it's, your board finding out or, you're on the wrong side of an SEC investigation or whatever, saying you didn't know is not going to be a good defense, personally or otherwise. So just, this is one of those things, again, legal. I have a lot of like ridiculous sayings or whatever, nothing like, your analogies and stuff like that. But I just think
Thank you.
Legal and finance are the two things you don't want to mess up, because those can be potentially fatal mistakes to your company. You can undo almost any other decision in your company. Oh, you hired the wrong person, that's fixable. Wrote the wrong code, fixable. Got the wrong customer, fixable. But, run out of money or get sued or whatever, those things can be hard to reverse. So legal and finance, you got to cover your butt on.
Yeah, the only thing I'd say here that I think is going to be interesting for Carta is that, and I don't know the exact numbers, but their most recent raises have been in like the 10 billion plus valuation range. If all they are is this, managing your cap table, and those investors expect to get a return on their money, boy, that's going to be tough in this market. And we didn't get to the whole startup valuations conversation. Maybe we'll try and tackle that next week, but if Carta really isn't getting into another market, the folks that have invested in the last couple of rounds probably aren't ever going to see daylight on their investment.
Yep. Oh, yeah. That's a different topic entirely.
It really is. It really is. But thanks for folks who are tuning into the first video episode of the show. I don't have any, well, actually, I do have some travel scheduled. I have a quick Vegas trip, and so you and I will have to work out our scheduling because now we have to do this when I'm actually going to be in front of a camera. So that's to figure out for next week. But for folks who haven't tuned in before, Paul dragged me around the country for a couple of years, about 5 years ago, on a tech tour when he was living in an Airstream. And we are going to be reenacting that. First tour stop is coming up in about 4 weeks in Sioux Falls, South Dakota.
Yeah, That's wild.
And then some more scheduled throughout the year. So look for us hopping up on the map around the country. I assume you're going to put the tour stops on resultsjunkies.com.
Yeah, I need to actually figure out where they're going to live, but yes, I'll get them up on the website.
I thought we had a page like resultsjunkies.com/tour or something like that. Come on, we gotta have that.
If only there was a website.
If only.
Yeah. No, I'll put it up on the website. Yeah, but we'll be out in Sioux Falls in February, and then Lubbock, Texas in April, and then we've got a couple other locations and dates that we're almost locked in on, but I'll share those, and I'll put them on that website wherever I put that soon. So I would love to see people out there and meet as many founders as we can. I think it'd be a lot of fun.
All right, so you ready for this? We're going to close with this. I figured it out, and you took the page down. Tour.resultsjunkies.com was where it was.
Oh, yeah. I used a vendor years ago for event management and stuff like that.
Yeah.
And,
yeah. Resultsjunkies.com/tech-tour takes me outside your site to tour.resultsjunkies.com. You got to fire that up, man. Fire it up. We need a new page.
Yep. I'll add it to the list. I'm writing it down. Writing it down. All right, man. Well, safe travels. I'm curious to see how this video stuff goes. I think we're going to learn quite a bit. It's going to be a lot of fun.
I just don't know how many weeks I'm going to be able to stare at that other head behind you. So we'll have to work on that.
I think these could be. I should probably ship these around. I can't even.
No, please don't do this.
Maybe probably ship these things around. It'd be kind of fun.
All right. Talk to you, man.
All right, buddy. See ya.